They knew about the fraud. They signed off anyway. Then, they shredded the evidence. 89 years old, 85,000 employees worldwide, $9 billion in annual revenue. Arthur Andersen was the most trusted accounting firm in the world, until the day they chose money over truth and destroyed billions in evidence rather than face the consequences. Within months, the entire firm was gone. 89 years wiped off the map, not because they committed the fraud, but because they covered it up. And this is exactly how it happened. Arthur Andersen was not just any accounting firm. It was the gold standard, the firm every accountant wanted to work for, the firm every corporation wanted auditing their books. Founded in 1913 on a single powerful principle: think straight, talk straight. Auditors who answered to truth, not to power. Accountants who would walk away from a client rather than sign off on a lie. For 89 years, that principle held. Then, Enron happened, and everything collapsed. To understand how Arthur Andersen fell apart, you have to understand how they changed. In the early days, auditing was everything. Andersen auditors were known for being tough, independent, uncompromising. If the numbers were wrong, they said so. If executives were hiding something, they found it. If a client pushed back, Andersen walked away. That was the culture Arthur Andersen built from day one, and it made them the most respected accounting firm in the world. But in the 1990s, something shifted. The firm started pivoting toward consulting, management consulting, business strategy, corporate restructuring. And consulting was far more profitable than auditing. Auditing fees were fixed and competitive. Consulting fees were enormous and flexible. So Andersen started building massive consulting divisions, and the incentives changed completely. When you are making hundreds of millions of dollars consulting for a client, you do not want to alienate that client. You do not want to point out problems in their books. You do not want to ask uncomfortable questions. Because if you do, they might fire you. And losing a consulting contract worth hundreds of millions of dollars is something no partner wants on their record. So the culture of independence started to erode, slowly at first, then faster. Auditors who were tough got pushed aside. Partners who asked hard questions got marginalized. And the clients who paid the biggest consulting fees got the most accommodating auditors. That is how Arthur Andersen walked directly into the Enron disaster. Enron was one of Arthur Andersen's most important clients. The relationship went back years. Andersen was not just auditing Enron's books, they were consulting for Enron on a massive scale, generating over $50 million a year in fees from Enron alone. $50 million every single year from one client. And Enron's executives knew exactly what that meant. It meant Andersen needed them more than they needed Andersen. It meant Andersen would find ways to make the numbers work. It meant Andersen would sign off on accounting structures that no truly independent auditor would ever approve. And that is exactly what happened. Enron used complex financial structures to hide billions in losses, special purpose entities, off-balance sheet partnerships, accounting tricks designed to exploit loopholes and deceive investors. Arthur Andersen's auditors knew about these structures. They reviewed them. They analyzed them. They understood exactly what they were designed to do, and they signed off anyway. Year after year, quarter after quarter, Andersen auditors put their names on Enron's financial statements, knowing the numbers did not reflect reality, knowing investors were being deceived, knowing employees were pouring their retirement savings into a company built on lies. And they signed off anyway. Because $50 million a year made the truth very easy to ignore. When Enron collapsed in December 2001, it was the largest bankruptcy in American history at that time. Billions in investor losses, thousands of employees wiped out, and Arthur Andersen was suddenly in the crosshairs. Regulators started asking questions. How did Andersen miss this? How did auditors sign off on financial statements that were so obviously fraudulent? And Arthur Andersen faced the most important decision in their 89-year history. Come clean cooperate, take responsibility, or fight, destroy evidence, obstruct justice. They chose to fight. And in doing so, they destroyed themselves. In October 2001, as the SEC investigation intensified, a partner at Arthur Andersen named David Duncan made a devastating decision. He instructed his team to begin destroying documents. Thousands of emails related to the Enron audit, thousands of physical files, all of it shredded, deleted, erased. Employees at Andersen offices across the country received instructions to destroy Enron-related documents. Paper shredders ran around the clock. Hard drives were wiped. An entire paper trail of evidence that could have shown exactly what Andersen knew and when they knew it, gone. Or so they thought. But investigators found what was missing, and they found emails that had not been deleted in time. Emails that showed Andersen partners discussing the Enron audit, discussing the accounting structures, discussing what could be defended and what could not. The cover-up was exposed, and it was far worse than the original crime. David Duncan pleaded guilty to obstruction of justice. He cooperated with prosecutors and pointed the finger directly at the firm's leadership. But the Enron disaster was not the only problem, because at almost exactly the same time, WorldCom collapsed. $11 billion in accounting fraud, the largest accounting fraud in American history. And the auditor who had signed off on WorldCom's books for years, Arthur Andersen, the same firm, the same partners, the same culture that prioritized client relationships over truth. Two of the biggest accounting frauds in history, both audited by Arthur Andersen, both signed off on by Andersen auditors who knew or should have known the truth. It was too much. The firm's reputation was not just damaged, it was obliterated. Clients started leaving immediately, not slowly, not one by one, in floods. Within weeks, Arthur Andersen had lost over half its major clients. Companies that had trusted Andersen for decades walked away overnight, because no company wanted their books audited by a firm under federal indictment. No investor would trust financial statements signed off by Arthur Andersen. No bank would accept Andersen-audited accounts. The firm was toxic, and everyone knew it. In March 2002, Arthur Andersen was indicted on federal charges of obstruction of justice, the first major accounting firm in American history to face criminal indictment. The firm that had survived the Great Depression, that had survived 2 world wars, that had built its reputation over 89 years on the principle of integrity, was now facing criminal prosecution. And the moment that indictment was announced, the firm was finished. Because you cannot audit the books of America's largest corporations when you are a convicted criminal. By August 2002, Arthur Andersen had effectively ceased operations. The firm was dissolved. 85,000 people out of work. Not because they committed fraud, but because the leadership of their firm chose to cover it up. Partners who had spent their entire careers building the firm's reputation lost everything. Young accountants who had nothing to do with Enron or WorldCom lost their jobs overnight because of decisions made by people at the very top of the organization. In June 2002, Arthur Andersen was convicted on all counts of obstruction of justice. The conviction was later overturned by the Supreme Court in 2005 on a technicality related to jury instructions. But it did not matter. The firm was already gone. You cannot undissolve an 89-year-old accounting firm. You cannot win back 85,000 employees who have already found new jobs. You cannot restore a reputation that has been publicly destroyed. The conviction being overturned meant nothing. Arthur Andersen was finished either way. The collapse of Arthur Andersen changed American business forever. Congress passed the Sarbanes-Oxley Act in 2002, the most significant overhaul of American accounting and corporate governance standards in decades. New rules on auditor independence, new rules on document retention, new criminal penalties for executives who certify fraudulent financial statements. All because Arthur Andersen chose consulting fees over independence, chose client loyalty over truth. chose to shred documents instead of face the consequences. Arthur Andersen was founded on 4 words: think straight, talk straight. For 89 years, that principle guided the firm through every crisis America faced. But when it mattered most, when Enron was hiding billions, when WorldCom was cooking the books, when regulators came knocking, they did not think straight. They did not talk straight. They picked up the phone and told their employees to start shredding. And the firm that defined professional integrity in American business was gone within months. This is Boardroom Fallout, where billion-dollar lies come to light. If this story shocked you, subscribe now, because every single week we are exposing another billion-dollar lie, another powerful company that fooled the world, and another story that proves the same truth every time. Greed destroys everything it touches. See you next time on Boardroom Fallout.